Welcome to The Explainer. I am absolutely thrilled to have you here today. If you've ever found yourself just staring at a stock chart, watching those daily red and green candles bounce all over the place, and wondered what actually matters over the long run, well, you're in exactly the right place. Today, we're cutting right through that daily noise. We're looking straight at the hard, fundamental data of India's biggest companies, the Nifty 50. We're going to uncover the 5-year growth champions and figure out what genuinely drives long-term stock market success.
It's really the ultimate question, isn't it? Every single day we're bombarded with news alerts, market tips, and temporary panics. But what actually separates the companies that create real, generational wealth from the ones that just kind of bounce around? Okay, let's dive into this, because the answer honestly isn't some secret formula. It's actually sitting right there in plain sight within the financial statements. I want to anchor our entire analysis today on this one super powerful sentence from the financial data experts over at MoneyWorks for me. Stocks with high profit growth often witness their stock prices gaining, irrespective of the market movements. That right there, that's our North Star today. Corporate health and actual earnings are what dictate market success. Over a few days, sure, a stock price is a popularity contest. But over 5 years, it's a weighing machine. To actually weigh these companies properly, we use what's called fundamental analysis. As our guide from Vesai clearly lays out, this is all about evaluating the underlying business itself. We aren't looking at chart patterns here. We're looking at revenue growth, operating margins, and EPS, earnings per share. Consistent earnings growth is the real engine behind long-term stock price appreciation. It's what helps us answer that one absolutely critical question. Is this a good business at a fair price? So, moving into Section 1. Champions of sales growth, where we'll be identifying the Nifty 50 revenue leaders. Now, before a company can generate massive profits, it usually needs to, sell a lot of its products or services. So who are the companies that have successfully expanded their top line over the last 5 years? Consistent double-digit revenue growth is the ultimate indicator of strong market demand. And looking at the data, we've got Trent Limited leading the pack with a staggering 57.27% 5-year sales growth. Coming in close behind is Eternal Limited at 50.70%. Then we've got the diamond and jewelry powerhouse, Titan Company, at 30.36%, followed by Max Healthcare at 27.27%, and the automaker Mahindra and Mahindra rounding it out at 26.68%. Now, what's really interesting about this slide is the massive leap between those top two and the rest of the pack. Trent and Eternal aren't just growing, they are literally compounding their top-line revenue at over 50% for 5 years straight. As the Vestai analysis points out, consistent double-digit growth in large companies is excellent, but 50%? No way. That is a real testament to aggressive scaling and just fierce market dominance. All right, let's shift gears to Section 2. Leaders in profit growth. These are our bottom line champions.
As any seasoned investor knows, it's not just about the money you bring in, it's about what you actually keep. This is the ultimate proof of operational efficiency and pricing power. And looking at our bottom line champions here, do you notice something pretty cool? Mainstays like Titan Company and Mahindra impressively appear on both lists. They're growing their sales and they're translating those sales into highly efficient profit growth right there in the mid 30% range. But you really have to look at the very top of this list. 155%. Let the sheer size of that fundamental metric just resonate with you for a second. That is Max Healthcare's 5-year profit growth. I mean, they're expanding their top-line sales by about 27%, but their profitability is just skyrocketing by 155%. That indicates absolutely incredible operational leverage. It basically means as they get bigger, they are getting significantly more profitable. And this brilliantly illustrates how vastly different sectors can generate immense bottom-line value when they're managed well. You've got healthcare facilities with Mox, the airline industry with Interglobe Aviation, which is the parent company of Indigo, posting 63.06% profit growth, and then infrastructure and trading with Adani Enterprises at nearly 52%. It totally proves that high profit growth isn't limited to just one trendy sector. You can find it across the broader economy if you just look at the fundamentals. And that includes massive financial institutions, which we're going to look at in just a moment. That brings us to Section 3, pricing growth, or looking at the valuation context. Because frankly, finding growth is only step 1. Step 2 is determining if the market is actually pricing that growth fairly, because overpaying for a great business can still turn out to be a really bad investment. This is where our financial tools and ratios come into play. We look at metrics like PE, which is simply the price investors are willing to pay for each unit of earnings. For example, a company with a super high PE like Eternal, which sits at over 1,000, reflects immense market confidence in its future growth. Contrast that with a stock like Coal India, which has a low PE of around 9, but offers a very steady dividend yield of over 6% for income-focused investors. We also look at ROC for capital efficiency and, of course, ROE. So the crucial point is right here. If you are forced to pick just one ratio as a beginner, the Vesti Stock Analysis Guide highly recommends return on equity, or ROE. It's essentially the ultimate gauge of management quality. If a company can consistently maintain an ROE above 15 to 20%, it shows they are absolute experts at taking shareholder money and turning it into real compounding profits. Moving on to Section 4, Earnings Showdown. We're going to do a quick case study on ICICI versus HDFC for Q1 FY27. Let's actually apply these concepts to the real world. When we look at major financial institutions over a 5-year trajectory, we see incredible structural profit growth across the board. State Bank of India is sitting at 30.54%, Axis Bank at 29.63%, and ICICI Bank at 24.51%. But how does that long-term strength hold up right now? Well, let's look at a highly watched Q1 FY27 showdown between ICICI and HDFC. ICICI had an incredibly clean quarter. Their standalone net profit jumped 15.9% year over year, and they actually improved their net interest margin, or NIM, to 4.36%. They are displaying robust financial health and just superior profitability. On the flip side, HDFC Bank, while obviously still a giant, showed only 5% profit growth, and their NIM slipped to a record low, 3.26%. Why? Mostly because they're still carrying elevated costs from their massive 2023 merger with HDFC Limited. So, while HDFC might lead on loan growth, ICICI wins clearly on the quality of earnings and margins for this specific quarter. It perfectly highlights how operational efficiency drives real fundamental strength.
Which brings us to our final thought. The data doesn't lie, guys. Companies like Trent, Max Healthcare, and ICICI Bank are showing us exactly what structural, fundamental growth looks like. So I'll leave you with this question to consider for your own financial journey. Are you going to keep chasing short-term market tips and daily noise? Or are you ready to start applying a structured approach to find the next 5-year profit champions? Thank you so much for joining me on this explainer. Keep learning, and I'll catch you next time.